Well, a lot of people are scratching their heads right now, trying to understand why US natural gas prices have gone vertical over the past 3 weeks. The obvious explanation would be the recent cold spell, but let's be honest with ourselves, it lasted only a couple of days, and now we're staring at another extended warm shift that could stretch all the way to the end of November. A brief shot of cold in what's otherwise shaping up to be a warmer than normal November simply does not justify a rally to $4.60. The real issue is that the major market players, the ones who actually have the power to push the trend up or down, rely on advanced, long-range weather models that go far beyond the 15-day forecasts available to the rest of us. That means they may be seeing something deeper in the data, something that hasn't fully filtered into the public models yet. I've mentioned before that La Niña is expected to dominate this winter, and historically, that's not exactly bullish for natural gas. A La Niña setup tends to produce warmer than average conditions across the southern US, much of the East Coast, Florida, and even parts of California. Yes, colder anomalies can still show up in the Pacific Northwest and the upper Midwest, but when you compare that with regional gas consumption patterns, it becomes clearer why La Niña winters usually lean bearish. I'll break down that consumption map and explain the dynamics in my next weekly outlook, so make sure you're subscribed if you want a deeper understanding of how La Niña shapes demand. Now, here's where things get genuinely interesting, and potentially explosive for both weather and energy markets. Early long-range models are hinting that something unusual may be developing in the stratosphere, prompting meteorologists to warn that the atmosphere might be approaching a critical turning point. What unfolds in November could become a genuine fork in the road for the entire winter season. Several model runs are signaling the possibility of a sudden stratospheric warming event. It sounds counterintuitive, but when the stratosphere warms dramatically, it can actually lead to much colder weather at the surface. In an SSW event, temperatures above the North Pole can spike by more than 100 degrees Fahrenheit within just a few days, causing the polar vortex to weaken and shift southward. That disruption allows Arctic air to spill into the United States. If such an event does occur this month, it would be unprecedented in the satellite era. The last November SSWs on record occurred in 1958 and 1968, long before modern observational tools. I'm generally cautious about relying on pre-satellite stratospheric data, so a genuine November SSW now would be nothing short of extraordinary. Should this scenario unfold, the polar vortex suddenly becomes a central player in the winter outlook. But it won't act alone. La Niña is still very much in the picture, and the interaction between the two patterns is complicated. There's no simple winner-takes-all narrative here. Instead, the polar vortex will largely determine how cold it gets, while La Niña helps decide where that cold is directed. The crucial question is how effectively a stratospheric warming event couples with the troposphere, the layer of atmosphere where our day-to-day weather actually occurs. If the coupling is strong, we could see a prolonged period of colder than normal weather beginning sometime in December and possibly extending into early January. That would sharply shift the odds toward a notably colder US winter. But if that coupling fails or only partially materializes, the cold risks fizzling out before it reaches the surface, leaving the country under a broadly mild pattern, and in that case, the probability of an overall mild to very mild winter increases significantly. So after hearing all of that, you're probably thinking, alright, but what on earth does any of this actually mean for natural gas prices right now? And honestly, fair question, because we still don't know whether this winter wants to be a freezer or a Florida vacation. But here's the part that won't surprise anyone: the big players, the ones who actually move this market, are happily exploiting that uncertainty. As usual, they're using every wobble in the forecast to stir up speculation and push prices around long before we even get clarity on how cold it'll be. And why? Because they're already positioning themselves ahead of the potential price decline many expect in the first and second quarter of 2026. I'll break down that whole setup, the timing, and what's driving those expectations in my next weekly outlook, so stay tuned. From a technical perspective, unless a meaningful burst of cold air shows up in the very near term, the short-range outlook leans clearly bearish. The market's inability to hold above $4.65, combined with a firm rejection at the 200-day moving average, points to fading bullish momentum. A decisive move back below the threshold would likely open the path toward deeper retracement targets in the $4.30 to $4.15 zone. On the fundamental side, elevated production, a bearish storage build, and milder weather suppressing demand all keep the balance tilted in favor of sellers. Bulls may try to defend support levels, but without a notable pattern change or a meaningful pullback in supply, any upside attempts are likely to fizzle out just as quickly as they appear. Please don't forget to check out the ads and leave a comment to support the channel. See you next time.